Welcome, everybody, to this week's podcast episode for the Financial Freedom for Physicians podcast. I'm your host, Dr. Christopher Liu. And as we talk about four pillars of freedom: financial, time, location, and health freedom. And in that regard, I started this podcast to reach out and spread the message of hope and freedom and opportunity. And I'm always trying to connect investors with the audience, entrepreneurs, business owners. So today we have Michael Episcope, and he is the CEO of and co-founder of Origin Investments, and with over 5,000 units and completed 2 billion in deals. So he's the real deal, and he's going to talk all about his bio background, and we'll go from there. So Michael, welcome.
Thank you, Chris. Appreciate being here.
Yeah, I know we were backstage, we were discussing the mess of the healthcare, and then but you had actually interesting career. You were trading, and you're actually in the financial, you were in the nitty gritty. So tell us about your story and how you got started, and we'll go from there.
Yeah, it's funny. Everybody thinks the other person has a more interesting career than they do. But thank you for that. Yeah, so trading was interesting. I'm born and raised in the Chicago area here, and we have always been the capital of commodity trading. And so when I went to college here, I went to DePaul University, and between my freshman and sophomore year, I got a job at the Chicago Mercantile Exchange and decided I absolutely loved it. And it's funny, that was marked really the start of my first career. And I have a 20-year-old now, and he's a sophomore in college. And I was already 2 years into my career unknowingly at that time. And it was great. I really loved it down there. And I stayed down there, and I was a student of the markets and worked my way around. Didn't really know what I wanted to do. So I was a clerk. I was a runner. I started working my way into the pit. I was a broker. And ultimately in about 1997, January 1st of 97, I stepped into the pits. I was backed by a hedge fund at that time, and I was really good at it. So my learning curve was quick. It was funny. I remember in the first month, I lost $7,000, and I had a huge pit in my stomach, and I was almost going to get sick, and I wanted to write them a check back. But it took off from there, and I learned how to make money and do things right down there. And that became a really good point in my life that lasted about 10 years in the trading pit. Those are kind of like dog years, if you will. Every year represents about 7 years of life. And in the beginning, people always ask me, why did I leave? In the beginning, I was single. I had just met my wife in 1997. We got married in 99. So when you're in the beginning of your career, when you're taking risk and there's nobody really to look at, if you lose everything but yourself, it's very different. And I had done well in that career, but by the time sort of 9-10 years came around, I was married. I had 2 kids. I had one more on the way. I had stacked up more chips than I ever set out to. And I said, you know what, it's time to go in a different direction here and look at how do I protect what I have, preserve what I have, grow what I have. And at that time too, computers were coming into the market. So the edge that we had was slowly disappearing. So I left that business in the end of kind of 2005, was still trading off the floor. In 2006, I enrolled. I got a master's in real estate. I knew I wanted to be in real estate. I had been exposed to it as younger. My grandfather was in it, and he just enjoyed the benefits of multifamily, passive income. And I always saw it because I was like, does Grandpa even work? What does he do? And that's really what you're looking for. So how do you turn your assets into income? How do you generate passive income? And at the time, I didn't really know where I wanted to go or what I wanted to do. I was investing passively, and my partner and I got together, and we had invested a lot together, different things. I invested alone, and it was always like, it was 2 steps forward, 1 step back. And candidly, it was sometimes 3 steps back and getting punched in the face. And you're, man, there's got to be a better way. And we just said a few words that made a big difference. Look, we can do this better. And that was it. And that was the start of Origin, was the idea that we can build a better investment firm around our own capital for people like us. So in 2007 to 8, 9, it was only our own capital. Then we started bringing in outside capital during that standpoint and just really showing people what we could do. And then also hiring and building infrastructure. And I know this is long, maybe longer than you want. So I'll take you through the arc of Origin. So I call Origin 1.0. So from that 2007-8 period all the way through 2015. And it was only in 2015 we said, look, we have a great product. We were already tracking top decile. We were, our investment partners really loved us. And when you have a great product and you put it in front of a lot of people, they're going to buy it. we engaged on a digital marketing campaign, brought in marketing resources in. We'd never done that before. And we went from 85 investors to 500 in the next 2 years. And then fast forward, I'll take you through. So today we have 32, maybe 3,300 investment partners. We have 1.3 billion in equity under management, and we have about 10,000 units in some stage. Some are built, some are in development, some are in pre-development. So it's been a great run. And I think what I'm most proud of is we have 50 team members today. They are just incredible people to come in to work every day with, and they inspire me and push me harder as well. It keeps me young. And then the fact that we've generated returns and we're considered a top decile manager, meaning we've beat 90% of other managers. And that, to me, like, not coming from the industry, really has vindicated what we've tried to do. Because I remember 10 years ago, before we just made that concerted effort to go all in on the individual, the high net worth, the ultra high net worth, the family office, we were actually talking to institutions, and we didn't have that pedigree. And so you get that little chip on your shoulder and we're like, okay, you're lost. And so we've never looked back since that day one, but it's been a great run.
Yeah. It's so interesting because you started with trading and now you went into something more stable and consistent, which is real estate. And for physicians, real estate is the ultimate. There's so many doctors interested, especially on the passive side, because their time is extremely limited. So they're always looking ways to save taxes and really leverage their wealth, grow their wealth, which your firm does. We'll just start from the beginning with origin. The perfect wealth protection asset, how real estate benefits from both inflationary and deflationary cycles, which is very relevant for our times today.
Yeah, it is interesting. Real estate did incredibly well during the period where we had low inflation, lower interest rates. Really what you had are multiples expanding across every asset class. So real estate, if you go back 15 years ago, your cap rates were 7s and 8s, and today they're more around 4%. So you really had the multiple almost double, right? Which is the multiple. When I say cap rates, it's the inverse of sort of the PE ratio. And now you've got the expansion of cap rates as well. I would say 6 months ago, a year ago, cap rates were 3.25, 3.5. Today they're 4.25. We're using those in our models. And it really is. I would say that this is what people need to be cautious of, though, right? We are in inflation. If you're positioned ahead of that inflation, then you did really well. Now is not the time to be running in to real estate and saying, hey, I want to beat inflation. That ship is already sailed. And if you're positioned, that's great. Because when you think about a piece of real estate, it is an amalgamation of commodities. It has lumber, and it has steel, and it has glass, and it has everything that we've been looking at that has been causing inflation. And the biggest thing are housing prices and rental price increases. So it is a protector in that case, and it's held up very well in this environment. I just like looking at asset prices and the fact that inflation has leveled off and slowed down. Everything that we're looking at when we're running our predictive models next year, the year after, is that we're going to give back some of these gains. I don't think that's a surprise to anybody. Looks like a recession is on the horizon. 2023, most likely. The stock market is certainly predicting that. It has really been a great hedge, though, against inflation. And what I love about just real estate, and we're only in multifamily, so we build, buy, and lend. And we really, depending on the market cycle, so there's times that you want to be lending, there's times that you want to be buying existing properties, and there's times that you want to be building. And that depends on different parts of the cycle. But it offers the passive income, it offers the depreciation, it offers the appreciation as well. And this is something that people don't understand, but over the last kind of whatever you pick, 5, 10, 15, 20, 30 years, real estate has actually outperformed the S&P 500 over that time period. Now, you can look at individual assets, and there's always exceptions to the rule if you were in retail or if you're in office and things like that. But when you look at the core bucket and then you take things out, the industrial, the multifamily, those have done exceptionally well. And it's really been, especially for the ultra high net worth family offices, multi-billionaires, it's been the asset class of choice. And those are the ones who have traditionally over allocated. I will say this, and I'll go back to a point I made earlier. You can't just say, I want to get into real estate and go into any fund, because it's about how you enter the market, the basis you're in, the fees that people take out. Because going back to our decision, like, we would be with really good managers, but when they take 50% of the fees, you're like, Yeah, that deal really did great, but I didn't make any money. And then when you're with the subpar manager, the market goes up 40% and you're making 20. And you're like, why did that happen? So it really is, there's an art to it, but finding the right manager is super important. Making sure people are aligned with you, that you're investing in the right asset class, that they're buying and putting your money in at the right basis as well. So a lot for you to digest, but I could go on this topic for another hour.
Yeah. Yeah. When I was growing up, I always I studied a lot of wealthy individuals, and it seemed they either made their money through real estate, they had paying jobs and careers, and then they poured it into real estate or through the equity. So those kind of two. And then the other thing was, what market trends are you currently watching, and how to utilize market trends to get returns?
When you say market trends, so we do a lot of webinars at Origin. We're probably doing 3 a month right now for our various funds. Some are thought leadership, some are about our product. And we get themes of questions. And the biggest thing on people's minds today is what's going on with interest rates, what's happening with inflation. And interest rates are a big issue right now. And so it doesn't, where it impacts directly our financing costs and the ability to refinance property. So your proceeds are coming in a lot lower. We just finished a deal in Houston in your backyard, 4th and Navigation. So right down the street from you, probably. Go check that out. And this was actually a deal we started pre-COVID. So the pricing couldn't be better. The value is there. But now that we're talking to banks, the proceeds just aren't coming in to the level, anywhere near the level we thought they were, because of banks are now, they're pulling back. Instead of going to 65%, they're going to 55%. They have higher debt service coverage ratios, more covenants. And so that's some of the big things that we're seeing in the market, what interest rates are impacting. What people may not understand is interest rates also impact the for sale side. And the for sale side right now, I was at lunch with our marketing team today, and one of the individuals was in the process of buying a home. He got pre-approved for a mortgage. His mortgage rate is 675 today. And that is keeping so many people in apartments and away from buying, because homes have gotten more expensive to build, and certainly the mortgage rate. So now you have this trapped renter phenomena that's almost in some ways offsetting what's happening with the higher interest rates and the financing costs on that side. So there's headwinds, there's tailwinds to the interest rate side. And I think when you're also talking about the trends, so where we operate is strictly in the Sunbelt markets. So we're in the Southeast, which I consider Raleigh, Charlotte, Atlanta, Florida markets down there. We're making heavy bets into Jacksonville. And the biggest thing in multifamily real estate revolves around affordability. You have to make sure that when you build it, you can find renters who can afford to pay your rents. And we're still finding just great affordability around the Jacksonville markets. Tampa has become less affordable, Orlando less affordable as well. It's interesting. Atlanta just became, Chicago, where I'm at right now, we don't invest here, but it became more affordable than Atlanta. And that equation has slipped over even the last kind of 6 months to a year because of the price increases in Atlanta real estate. We're in Texas markets, Nashville, and then Phoenix and Denver. So we have a global view around the market. And if you notice, most of our markets are all the Sunbelt states, the lifestyle. And the biggest thing is low tax, because the work from home environment, you have CEOs who are now able to go remote. They don't want to live in places like New Jersey and New York. They're moving down to Miami, zero tax state. They're moving their headquarters down there. We've seen a lot. They're moving to Texas. They're moving to Tennessee. And it's really changed the dynamic. So I think what we've seen in the last kind of year or year and a half is that first wave of people who had the flexibility and the ability to move. And now we're going to see that trickle effect. This is a conversation now. I'm 52 years old. I have a son who's a sophomore. We're going to be staring at the empty nester life in a few years. The whole conversations are about, where are you going after your empty nester? Are you staying in Chicago? And people have plans to move to these lifestyle cities. Yes, they're more expensive, but it's still, there's only so much runway left in life. Where do you want to spend those days? And a lot of in sunshine, in the mountains, in low tax states. And there's been a trade. This was interesting. I was talking to a broker from Wyoming, and he said that people are coming, these wealthy CEOs are coming from California. They're buying $15 million homes, and they feel like they bought them for free because they're not paying the state of California that 13% tax anymore. They're like, I don't care what it costs. It's free as far as I'm concerned, right? Like, I'm finally writing whatever, the $500,000 check a year, but I actually can enjoy something. So a lot of that's happening. Chris, you can cut me off anytime.
No, it's great to you have a lot of knowledge and experience, and I just want the audience to soak it up. And the other thing is, in particular, in terms of taxes biggest consideration for high net worth individuals, high income professionals. And this idea of people talk about 1031 exchange, just roll over the profits, tax defer it, versus the QOZ investing. What describe that and tell how to investors can maximize their tax advantages.
Yeah. And so the 1031 exchange is it's a great vehicle and it's really unique. And I would say that if you have the means and you have the expertise and you can find somebody really good to help you with the 1031 exchange, it's probably the best product out there. Now, you will be concentrated, so it's a little bit different. I want to caveat that. But you should never let the tail wag the dog. And I've seen, for example, my mother, unfortunately, my grandfather left her Walgreens and she and my uncle decided to sell the Walgreens. And I got to save taxes. I'm like, Mom, just pay the taxes. They were 15% at the time. She rushed in, did a 1031, ended up paying a broker a large fee, right, that she didn't know was in there because these things are very fee heavy. And ultimately, that deal did not do well for her. It was absolutely the wrong decision versus just selling it. Now, that is hindsight, but the reason I say that is because the 1031 exchange market has huge fees in that market. And a lot of times you're saving on your taxes, but guess what? You're almost offsetting it on the fees you pay or the upcharge that you're paying on this property because if it's a $50 million property that you're paying $60 million for, guess what? You've just lost all that tax savings in it. QOZ is different in the sense that the Qualified Opportunity Zone law was passed in 2017, part of the Tax Cuts and Jobs Act. If you have a capital gain, it doesn't have to be real estate. It can be anything out there. It can be a piece of art. It can be stocks. It can be a PE fund. It can be long-term. It can be short-term capital gain. And you can invest those proceeds into a Qualified Opportunity Zone fund within 180 days of realizing that gain. I could spend another 5 minutes on those rules. 180 days, there's all different dates, depending if it's in your personal name or in a partnership. But the point is that if you have, let's say you made $1 million investment and you make $500,000 on that investment and you realize that gain, you do not have to invest the principal, which is a huge benefit. You only have to invest that gain to get the Qualified Opportunity Zone benefits. And the benefits are this. Number one, you get a deferral of those taxes. You do not have to pay those taxes. So if, for example, you're doing your taxes, it's October right now, all the taxes are due. If you decided, hey, I want to invest a 2023 gain into a Qualified Opportunity Zone, you wouldn't pay those taxes until 2027. It would be recognizable in tax year 2026. You would pay them in 2027. It's like a free loan from the government. Now, the risk is that tax rates go up and you're subject to whatever that prevailing tax rate is at that time. That's not even the best benefit of the program. The best benefit is this, that is, if you are in that program for 10 years and 1 day, you pay zero taxes on the gain. So if that $500,000 grows to $1 million, $2 million, $3 million, and you get out, you pay zero taxes. And you get the benefit of depreciation, you get the benefit of cash flow, you get all the tax benefits of real estate during that holdus period. So you might even get passive income losses against gains that you can offset against those. So it really is a fantastic program. I'm putting personally a lot of money into this to shield my taxes, which is just a great way to do it. So it's one of those things that you find very few, but it had bipartisan support in Congress by both the Republicans and the Democrats, and it's here to stay. And there's actually some law or some pending legislation where they're going to extend this and bring back a third benefit, which is a step up in basis. And that could happen by the end of this year, early next year. And what that means is that if you have a $500,000 gain, when you go to recognize that, you would only recognize 85% of that gain in the future. So that's the step up. And that's been something that went away this last year, but it could be coming back.
Yeah. Yeah, no, this has been really fascinating because there's so many ways of saving taxes. And that's the benefit of having guests such as yourself on podcasts and sharing the knowledge. I know a lot of the audience out there that's listening is really interested in Origin investments, and how can they contact you, visit your website, and work with you?
Yeah. Chris, let me touch on one thing because you said saving on taxes, and it's really important. We only deal with high net worth individuals. And one thing that we've done with our model is changed it from buy, fix, sell to buy, fix, and hold, because we just believe that real wealth is made by building, owning, buying quality assets forever and taking advantage. And I think that private equity, when it's used in real estate, that buy, fix, sell, if you're not in real estate for the long run, taking advantage of the depreciation benefits, there's other assets that you can probably get into that are better. But real estate is something that you should be thinking about holding for 5, 10, 20, 30 years and really taking advantage of those. So I just wanted to get that in there because it's been a huge mind shift at our organization where we've gone to open-ended perpetual funds, really thinking about how to build long-term wealth for our investors. And if anybody wants to contact us, your question, origininvestments.com. We make it super easy for people to interact with us. You can go to our website. You can download any of our decks. You can learn about us. You can connect with somebody in our business development department right there, schedule a call, and they will be happy to answer any of your questions.
Yeah. And for the audience listening, all of Michael's resources will be in the links and show notes. Be sure to check them out. And we hope to hear about your future success.